think it behooves anybody that has any kind of a scientific inclination, anytime they see something that contradicts what they believe is true, they really ought to pay attention to that and try to dig a little bit deeper. And
here, I just want to pause there and say this.
Highlight and underline that comment. Yeah.
Yes.
Welcome to the Gold Exchange Podcast, where we untangle market and policy complexity using timeless economic principles. For show notes and archives, go to goldexchangepodcast.com. Now, on to today's episode.
Hello, everyone, and welcome to the Gold Exchange Podcast. My name is Dixon Buchanan. I'm the Vice President of Marketing for Monetary Metals, and I'll be hosting today's episode. I'm joined by Keith Weiner, the founder and CEO. I'm very excited about today's episode because we have the Paul Bellinger as our guest today. Paul is, in my opinion, one of the premier analysts on gold and investing, and I would say a real gift to the precious metal community. Let me unpack what I mean by that. If you spent any amount of time in the precious metal interwebs, which we all know can be a dark and gloomy place at times, it is excruciatingly difficult to find solid, unbiased, well-researched analysis on precious metals. And that's because the vast majority of what passes for analysis is simply pandering to people's fear or greed as they try to sell you something. There's the fear camp, which is epitomized by the dollar is going to crash tomorrow, so hurry up and buy your gold and silver now before it's too late. And then there's the greed camp, which is gold is on its way to $5, $10, nay, $60,000 an ounce, as we heard one commenter say one time. So you better pick up the phone and dial 1-800-BUY-GOLD now. And of course, these are two sides of the same coin, right? There's, the fear and greed are two sides of the same coin. So you get this kind of toxic cocktail where it's almost like how to profit with gold from the coming collapse, right? How to get rich with gold as the world burns around you. That's unfortunately what a lot of analysis is, but Paul is one of those rare breeds that doesn't do any of that. Instead, he has produced hundreds of videos and most recently a book, which include timeless data-driven analysis on the benefits of owning gold and how gold can help investors achieve their financial objectives. He's done all of this on his own as an independent thinker, researcher, and investor himself, all while concluding a successful career as a chemical engineer. Paul, Keith, and I are very pleased to have you. Welcome to the show.
It's a pleasure to be invited. Thanks for having me.
Great. So before we get started, I want to briefly mention a few ways that our audience can connect with Paul and his work. First, there's his YouTube channel. Most of his analysis, I want to say going back to almost a decade, Paul, if that's right.
That's
How long
right.
have you, about a decade, Paul has been producing videos on his YouTube channel, which is called Belong P. That's BELANGP. Highly encourage you to press pause right now, find Belong P on YouTube and hit subscribe on his channel. You'll thank me later. In addition to YouTube, Paul has published, just recently published, I believe last month, published his book, which is called Evidence-Based Wealth, How to Engineer Your Early Retirement. And that can be purchased on Amazon. Any other place that can be purchased, Paul, or is that the best?
Just Amazon for now. Yeah.
Just Amazon. Okay, great. Last but not least, he is also the owner and author of Evidence-Based Wealth, the website, which contains his written analysis. I'm sure most of you are probably familiar with Paul watching his videos, but he does write as well. He does publish written word content on his site, and I can attest that it is as good as his videos are. So be sure to check out his website. We'll include links to all of those in the show notes once we publish this episode. Okay, so for today's episode, I think it's only fitting that we take a deep dive into gold on this episode. Between the two of you, Keith and Paul, we have a large amount of combined knowledge on gold in this room right now, in this virtual space. We might break your speakers or crash the internet with the amount of gold knowledge between the two of you. So I think we should take that second layer, third layer down into gold in today's episode. And I think what would be particularly interesting is to cover, because when I think about both of you, you've arrived to similar conclusions on gold, but you've taken very different paths to get there. So I think that would be really fruitful ground to cover for today's episode. Obviously, our audience is going to be familiar with Keith and his work, so we should focus more on you, Paul, and kind of let you explain and expound on your body of work and give Keith the opportunity to comment on that. Would love for you to kind of go through your research and findings on gold and tell us a bit about your methodology, kind of the tools that you use when you do your research. But why don't we start by just you, Paul, telling us a little bit about yourself, your background, and maybe how you were introduced to gold originally.
Sure. I'll try to keep it brief. So I graduated with my PhD in chemical engineering from Lehigh University in the mid 90s. And that's when I took my first job in the industrial world. And as we all know, when we first get a job, one of the first things that they do is they introduce you to the 401k. And that's when I decided that, hey, it would probably be a good idea to figure out how these things work and how to do it properly. So I did a deep dive into stock investing because that's primarily what they offer. And I gravitated towards the value investing school of thought. That's the Ben Graham's, Warren Buffett's, and so forth. And I thought it was really interesting stuff. It seemed like a good way to study stocks and figure out how to buy things that were better than what everyone else was buying. And one thing that caught my attention in 1997 was hearing that Warren Buffett had bought a lot of silver and was shortly thereafter persuaded to divest himself of it. But I found that to be very curious, and I started studying why it was that he bought silver. And long story short, I got into the metals. Unfortunately, I think I got into the wrong metal for the wrong reason, but it led me down a path that allowed me to understand gold eventually. So I started reading articles. As you know, the way that things usually work out is when you're looking for things to confirm your hypothesis, you tend to find all kinds of things. And I stumbled upon some work by Ted Butler, who had even compiled all of his articles into a book. So I read it, and I was thoroughly convinced that I was right. Unfortunately, later on, I found out that Mr. Butler had missed a bunch of fundamental things. For example, there's a lot of silver out there on the market, and it is being lent, not necessarily shorted to hammer things down, but it's being lent by bullion banks on behalf of their customers to make a profit. But anyway, as I went further and further down the rabbit hole, I started learning a little bit more about central banking. I learned more about the world of gold. I learned about the LBMA. I learned how things work on COMEX. I pretty quickly figured out that gold was one of those rare things that the common man could own in similar quality to what the rich families use in order to preserve their wealth during times of crisis. They can't afford fine art or the choicest land, antique furniture of the same quality as what the rich people own, but they can own gold. So over time, over the span of the 2000s, I not only accumulated stocks, but I started accumulating gold in addition to silver. And towards the end of, I guess it was 2010, 2000, at the beginning of 2011, I noticed something very curious, and that was the emergence of a lot of silver-oriented YouTube channels where self-proclaimed experts in silver were talking about how easy it would be to get super rich buying silver, and they were talking about the rules that they follow, how to buy silver Luna coins from the Perth Mint, how eventually we'd get back to a point where one silver dime would be equivalent to a day's wages. And the price of silver was going absolutely parabolic. And that's when I realized that it's probably time to lighten up because there's absolutely too much speculative activity in it. And I managed to, and this was fortunate, it was just luck on my behalf, but I managed to dump most of my silver and exchange it for gold when the gold to silver ratio hit about 35. I think I got a little bit out at 32, but it was just dumb luck, but I'll take dumb luck. I'm fine with that. And I just held on to the gold throughout the rest of the 2000s, 2010 decade, and added a little bit to it as time went on. But I continued to study, and that's when I learned a lot more about central banking and the relationship between gold and the value of currencies like the euro and the dollar, and also took a deeper dive into some statistical analysis around mixtures of bonds, stocks, and gold. And to this day, I basically follow a lot of the conclusions that I came up with on how the three assets relate to each other. So it was last year that I reached a point where I was able to retire. So I had reached financial independence. My company had merged with another competitor a couple of years before, and the cultures really didn't get along together. So it became a unpleasant place to work. So it seemed like a confluence of events kind of pushed me out the door, and that's when I started, putting out chapters in my book. I was providing them for free on my website, but I had to take those down recently due to a contractual obligation with Amazon when I actually did publish my book. But the website's still there with free articles, and I'm still producing videos on Blind P on YouTube. And so that brings us to the present.
I was going to say I have two things to add. One is I had my own thoughtful disagreement with Ted Butler, as he had put out this article. This is years, maybe a decade or two after you encountered him, in which he was taking the tone and the approach of like a professor emeritus who's an old man now and has made his contributions to the world, won his Nobel Prize, taught all the influential professors emeritus in the field at all the other top universities, and now in this magnanimous gesture, saying, hey, here's my body of work and here's my contribution, and if anybody has any thoughtful disagreement, I'd love to hear it. And so I wrote an article, said, okay, in that spirit, let me take you up on that. And first, let me attempt to summarize your argument that silver is manipulated using terms and framed in a way that you would have to agree with. And then based on there, then let me criticize the idea. And by that point, we had finally, so we've licensed what's called the Tick History Database from then Thomson Reuters, now Refinitiv. That contains every bid and every offer on gold and silver, both spot and every futures contract, going back to 1995, with sub-millisecond resolution, terabytes of data. So we first had to build a big data platform. You can't just shove terabytes of data into a SQL database. There you go. And then built our own data science platform to start analyzing it and normalizing and cleaning it up. And there's a lot of different data issues that you run into there. And anyways, by that point, we had the data to show what happens when every futures contract matures. And I said in my thoughtful disagreement with Ted Butler, I said, whenever two scientific theories compete, what scientists look for is an edge case where the two theories predict an opposite behavior. And then, so if physicists, if Einstein says that when we find a super duper pulsing magnetic quasar object in the distant universe, it's going to bend light to the left, and suppose Lorentz said it's going to bend, his theory would predict it would bend light to the right, then all of physics is sitting on the edge of their seat, waiting with bated breath for when we can finally build a telescope big enough to go find one of these objects. And then let's say we put the Hubble Space Telescope out there then everyone's like, chewing their fingernails down to stumps. Well, what is it? Is it left or right? Left or right? And then when the answer finally comes in, it's left. Then Lorentz's, theory is relegated to the ash heap of history. Einstein is vindicated, and life goes on. I said, so we have two theories here. One is that the banks are naked short, futures. The other is that the banks are arbitraging between spot and futures, and therefore you lead to opposite predictions. First of all, how this whole thing behaves, and then particularly when each contract matures, what would you predict from each of these theories? I laid that out, and I said, now, here's the data on 130 contracts, as every one of them is expired, all overlaid on top of each other, but you can see what happens to the silver basis and the gold basis, as you approach contract expiry, and therefore this proves definitively that it's not naked short manipulation, it's arbitrage. And anyway, with all that data, and what was interesting is, so that article was covered by everybody. It was on Zero Hedge, it was on GATA, it was on the Metropole Cafe, it was on like every possible site for gold bugs and alternative investing and alternative finance. I'm sure that Mr. Butler woke up that morning with 50 or 100 emails. Did you see what that guy Weiner said? What are you going to say? What are you going to say? It was every place that he would have had to have been reading, or certainly his fans and followers would be reading. Dead silence. Awkward.
Well, I personally believe that there is a certain amount of manipulation that happens on the precious metals markets, but I don't think that it's evidenced by pointing at JP Morgan and saying, hey, they've had 400 trading days without a single loss. I think that's just a sign that JP Morgan is doing bullion banking as opposed to trading. But you can see during thinly traded hours, occasionally a big trading house will try to run stops. So a common practice of traders is to just use technical analysis to explain everything, whether it's bond interest movements, stock movements, precious metals movements, commodity movements, and these technical traders do trade that way, and they put in trailing stops. So one of the easiest ways, I think, for a lot of the big trading houses to make money is to program some algorithms to seek out where these stops are during thinly traded hours and to try to run them. And then the computer-based trading will basically take over once those stops get hit, and it will drive the price down. And it allows the big trading companies to basically take advantage of what I would consider to be a fairly unsophisticated trader.
Yeah, and so they're front running. There's all kinds of things there. I mean, JP Morgan, one of their traders was criminally convicted of, now it wasn't running stops, but it was front running or spoofing, right? Putting out fake orders that they didn't intend to honor. I'm not sure how the heck a court would determine that versus a market maker that's arbitraging between GLD, futures, spot, forward, forward market, all kinds of different markets, and then maybe other ETFs that they're making a market in as well. How they would differentiate, and any one move in any one market would necessitate changing all the bids and all the offers and all the other markets. How the court would determine that versus an order that was put in without the intention to fill. But the guy was caught, for that and criminally convicted, and everyone wants to say there's your proof of manipulation. To which I say, Monte and Bailey fallacy, sir. The Monte and Bailey fallacy is when you have an uncontroversial but fairly useless, usually fairly small or trivial claim, such as somebody did something bad. The Al Capone's kid stole a candy from the 5 and dime store, and then using that to freely migrate to, and therefore, Al Capone is the godfather, and therefore the price of gold would be $60,000, and would have been $60,000 decades ago. But for this suppression, this dark cabal that keeps it for decades, keeps the price tens of thousands of dollars below where it should be. And anyway, so the article that I wrote in response to Butler doesn't address everything, but addresses specifically if they held this naked short position, what would happen, at expiry,
Right.
which is one of the leading claims that they make.
I think it's fascinating. I don't think there's too many investors in precious metals who can say that they got their start in precious metals from reading the likes of, Benjamin Graham and Warren Buffett, right? I mean, typically when you think of Warren Buffett, you think of this vocal opposition to owning gold and silver. But it's interesting to me that that's actually how you got introduced to those markets. I'm curious if you can fill in the gaps for us. So you're reading about value investing. You see Buffett make his silver trade, and then that's how you get into the metals yourself. But where when did you start incorporating this kind of data driven approach? Because you've produced all these videos, you've got, I mean, just gobs of data and research that you've done on portfolio composition and how gold and silver can occupy a role in a diversified portfolio. So like, connect the dots for us a little bit there.
Okay, well, going back to Buffett, one of the principles of science is that when you find something that doesn't make sense, there's an opportunity there to dig in and figure out whether your theories are wrong or if there's a data point that's wrong. And so I think it behooves anybody that has any kind of a scientific inclination, anytime they see something that contradicts what they believe is true, they really ought to pay attention to that and try to dig a little bit deeper. And
here, I just want to pause there and say this.
Highlight and underline that comment. Yeah.
Yes.
Yeah. So I mean, as I went through time and studied this, I came across a lot of different theories for how the world works. At least the world of economics. I mean, everybody has their models. Models, they make people comfortable because they tend to assign numeric values to things. But going back to my engineering studies, what I've concluded is that oftentimes the models that people form will reflect their own preconceived notions. So models are only as good as the assumptions that go into them, right? And so usually, especially the more elegant the model, the more you'll find that it's going to give back to you exactly what you think is going to happen based upon the inputs.
It reminds me when this kind of discussion comes up, all models are wrong. Some models are useful.
That's right.
I was thinking that same thing. Yeah, I was wondering who said that.
I don't know if it was Feynman or not. I seem to remember it coming up in Statistics for Experimenters by Box, Hunter, and Hunter.
What does it say, Box?
Yeah, so I think it was Box.
Maybe Dixon, if you can just put in the caption to the video, the link to the Wikipedia page or whatever for who came up with that.
Yeah, I'll find that. Yeah.
One of those subtle insights.
Yeah, but I mean, anyway, I mean, going back to theories. So the only way to really test a theory is to use data. And you're never really going to confirm that a theory is true, but you can certainly invalidate a theory. I mean, there's nothing that ruins a beautiful theory more than one data point that disagrees with it, right? And so I tend to focus on coming up with as much data as I possibly can. And whenever it tells me that there's something inconsistent with the way that I view the world, I tend to go back and examine my hypotheses and try to figure out where it might be wrong. So all that said, whenever you see all this, all the data that's been compiled in my videos and my writings over the years, one thing that you will probably notice is that there are a lot of conclusions that I drew early on when I was publishing these videos that I don't really hold to anymore. I just haven't taken those down. So it's kind of like a giant decade-long stream of consciousness that's led from the very beginning up until where it is currently.
That's great. I'm wondering, actually, just for the benefit of our audience, if you could spend some time and maybe maybe walk us through some of your greatest hits over the years, right? So some of like the big picture questions that a lot of precious metal investors have, you've kind of attacked those head on using a lot of data, and have produced really solid answers that I think are a real benefit to to the precious metal community that's looking for the answers to those kinds of questions. So I got a little list here. This is what I consider to be your greatest hits. You can add or subtract to this list, or we can spend time discussing something else. But so the first one I have here is you note just the problems with using Monte Carlo analysis. So why don't you unpack that one for us?
Okay. Well, as I said, people tend to like models. They're comforted by models, and especially when experts put together models, it tends to lead people to believe that the models are credible and you can do something useful with them. Now, a few researchers back in the 1990s, chief among them was Bill Bengen, who was first to publish this information, took a look at stocks and bonds, and the main question he was trying to figure out was, how much could a person withdraw from their portfolio each and every year without running a major risk of running out of money in retirement? And so he had compiled a lot of data through the 20th century, at least the data that was available on stocks and bonds, and he concluded that most of the financial analysts or the consultants were incorrect, because they were saying that because the stock market had returned 7% real on average over those few decades, people could feel safe withdrawing 7%. But he knew that that wasn't the case, because the stock market's volatile, and if you sell during a bear market, you're going to end up selling more of the stock than otherwise you would during an average year. So he tested the theories at the time by compiling decades-long periods of data, and concluded that no, the answer was closer to 4. Now, of course, that was a historical look. It's not a futuristic look. But unfortunately, if you take a look at the data that he had available to him, he was trying to answer how long would how could you make it so the portfolio would last you for 30 years? But if you're going back to the 1920s, and he wrote the paper in the 1990s, how many independent 30-year periods do you have? You really only have 2, right? But that was one of the key limitations of the work that he had. But a lot of financial analysts had basically globbed onto his work, and the paper that was written a few years later by researchers at Trinity College, which, by the way, they never even cited Bengen, which was a really weird thing. So a lot of financial analysts now, they've extended that work, and they think that they can use a tool called Monte Carlo analysis, which is where you take the statistical properties of the various asset classes. So they started with stocks and bonds, and then they included other assets such as commodities, gold, real estate, and things like that. And the theory goes that you can take a particular asset mix, do a lot of simulations on a computer using statistical distributions that have been collected over time, and come out with a precise answer for how long or a particular asset mix will last with a given withdrawal policy. Makes people feel very, very comfortable, because the computer simulations will spit out answers like, oh, you only have a 5% chance of running out of money after 30 years, or you only have a 2.1% chance of running out of money after 30 years. So it makes people feel very comfortable, very confident, and so they can basically say to their boss, okay, I'm leaving the workforce now. The 4% rule tells me that I'll be safe for the next 30 years. I'm good to go. So I had taken a look at that, because I was kind of curious about what would happen with mixes of gold and stocks, because some of my research had indicated that a gold stock mix was actually more predictable, more consistent in performance over especially the difficult decades of the 1970s and 2000 to 2010 than a stock bond portfolio was. And I used my own Monte Carlo analysis to analyze what would likely happen to various mixes for a person entering a 30-year retirement. And I found a couple data points that were inconsistent with, what some of my other work had said the results should be. And so I dug deeper, and what I found out was that one of the key assumptions behind Monte Carlo analysis is critically flawed, and that is the concept of the random walk. Are you familiar with what a random walk is?
Yeah.
Okay, so a random walk basically says that future performance is completely independent from current performance. In statistics, you refer to that as independent variables, time invariant. So it says that, all right, if you have 7% return in stocks this year, you can't use that to predict what's going to happen to stocks next year or the year after that. So no amount of past data will tell you what's going to happen in the future. And to a certain extent, that's true for individual asset classes because the markets tend to be somewhat efficient. And so if you could use the past in order to predict the future, everybody would do it. And I believe that a lot of people do try. And in so doing, when they try, they tend to remove any predictive capabilities because it tends to be priced into the market at any point in time. But the key assumption in Monte Carlo is basically that you can take standard deviations of returns and correlate cross correlations between assets and use that to predict what's likely to happen in the future. So you do your simulation for this year, then you do another simulation for the following year, then you do another simulation for the year after that. And none of it is dependent upon anything else. It's a true random walk, just like a drunk walking down the street. You don't know which direction the drunk's going to go, but maybe he'll manage to meander down the street after successfully, bouncing off a couple buildings. But the problem with that is that the correlations between stocks and bonds actually tends to grow over time. So if you hold stocks for 1 year, the correlation between them, the Pearson R correlation, is about 0.3. So that's for a 1 year holding period. And for stocks versus gold or bonds versus gold, it's basically zero. So there's almost no correlation for a 1 year holding period. But if you look at a 5 year holding period or a 6 year holding period or a 7 year holding period, the correlation between stocks and bonds actually becomes fairly high. And the negative correlation between stocks and gold or bonds and gold is actually very negative. So we're talking about 0.7 between stocks and bonds and minus 0.8 between stocks and gold. And what that says is that if you have a long stretch of time when bonds or stocks are doing better than average, there's a pretty good probability that gold will do worse than average, and vice versa. It's almost as if gold is the forgotten asset when bonds and stocks are doing well. But then when stocks and bonds take a turn for the worse, all of a sudden everybody gets religion and they start paying attention to gold again. And so we get periods of time like the decade of the 1970s.
Let me just interject. What makes sense from a theory perspective, being money, it's the thing you hold when there's no other investment or no other speculation that you prefer based on a risk return analysis. So gold is the thing you own when there's nothing else you want to own, which is exactly what you're observing in this negative correlation. Like when stocks are going gangbusters, everybody wants to own stocks. They sell the gold to buy more stocks.
Right. Except they do it in the rearview mirror. I mean, until early this year, stocks had insane valuations and bond yields were very, very low. But you didn't have many people coming out of the woodwork and saying, buy gold, you should stay away from stocks and bonds, right? These guys, what's the old saying? I think it was Upton Sinclair said, you'd be amazed at how much people can ignore when their livelihood depends on them not knowing it. It's not an exact quote.
That quote, it's impossible to teach somebody something that his salary depends on him not knowing. The
Right.
quote I was thinking of was Roy Rogers, who said the key to making money in the stock market is to buy the stocks that go up. And if they don't go up, don't buy them.
Yep.
Rear view mirror.
So anyway, back to Monte Carlo. So because of that strong negative correlation between gold and the financial assets and the strong positive correlation between bonds and stocks, I think people are misguided by using Monte Carlo from doing any kind of prediction, because you will end up with decades such as the 70s or 2000 through 2010. And Monte Carlo is an invalid tool for trying to predict that kind of thing if you don't include that kind of information in it.
So that's a problem with data science more broadly, right? Is if you don't understand the causality of anything, you're just looking at data, it's so easy to trip yourself up. It's so easy to make a bunch of assumptions. Maybe a few of them aren't quite right, but whatever, and you just plow on forward, and then you end up with, a conclusion that because it comes out of a computer, seems like it's got a lot more weight than it actually should have. And by the year 2020, the Earth will be so hot it won't be able to sustain life, and and that sort of screaming headline that that it makes when somebody with sufficient gravitas announces it. But what do you really have at the end of the day? Garbage in, garbage out.
Right. And that's what personally I think makes the Federal Reserve right now so dangerous in their policies, is that you have a lot of PhDs who have studied data in the past and they've come up with some very, very elaborate models. But what they haven't done is they haven't built in the capacity of human psychology to change. And so I happen to believe in an old thesis of Ludwig von Mises, which is that for things that are economic, you're almost best off not trying to quantify them, because it's driven by people's psychology more than anything else.
Well, and the fundamental uncertainty of the entrepreneur. You think you know what all the jobs are that we need, and then the entrepreneur creates a new industry, and suddenly there's 100,000 jobs that we didn't think we needed 6 months ago, and the Fed is trying to manage. One of those anomalies that nobody ever seems to ask the question. Remember earlier when I paused and I said this: you have a theory, right? And then you go out and look at the world, and when the world contradicts your theory, you've got to ask some questions. And one of those questions that nobody asks is quantity of money the singular cause of rising prices? And so as early as, at least going as far back as Newt Wixell in the 1890s, Wixell went out to try to prove that, because he was a monetarist, and then proved that actually there isn't really a correlation between quantity and prices. The correlation is between interest rates and prices. As rising interest rates correlate with rising prices, falling interest rates correlate with falling prices. Later, a guy named Gibson comes along, and then they name it Gibson's paradox. Perhaps only so called because their theory doesn't get it, predicts it wrong. This whole thing seems to be forgotten, and back today we're to, okay, well, we have had inflation, and therefore the Fed should hike interest rates. Two problems with that. One is that the cause of rising prices today is clearly disruptions caused by trade war, green energy restrictions, and the lockdown and the consequent unlock and what it's done to logistics and supply chains. And now finally, Ukraine war. Ukraine was one of the biggest exporters of both fertilizer and grains. And that's clearly offline this year. And we'll see about next year, but for this year, that's gone offline. What does that do to prices? Well, obviously skyrocketing. But even from a monetary perspective, if you have higher interest rates, that means higher input costs to every producer. And the theory is this is going to cause lower prices. Anyways, if you look at the 1970s, actually 1950s through 1970s, you see a great correlation between rising interest rates and rising prices. rising interest rates was supposed to correct all this, why did accelerate inflation just keep accelerating? And then the moment that inflation is supposedly broken, we have a falling interest rate from 1981, arguably through present, although right now we're in the middle of a correction. It's one of those things where the theory doesn't match the observed data, and so therefore people just ignore the data.
Mhm.
That's much easier than challenging the theory.
Yeah, yeah. And of course, as prices rise, the real danger is when the average everyday person starts to expect continuous price rises and ever increasing rates of price escalation, and they start taking action accordingly, and that tends to feed on itself, and it becomes a positive feedback loop.
That was the 1970s in a nutshell.
Yep.
My parents got to the point where, and I know a lot of people did this, I don't think there's anything unique about my household, would go grocery shopping, and then like whatever was on sale, if it was durable, like let's say cans of tuna fish or paper towels or toilet paper or dishwashing detergent or whatever, would just buy like enough for a couple of years.
Right.
And I use the term, they traded a bank balance for a pantry balance. That goods in the pantry were of known and predictable value, and cash in the bank was not. Then the real danger, so that's positive feedback loop number one. Positive feedback loop number two, which feeds on that and makes it worse, is corporations get in on the act, because they can sell bonds to finance ever increasing hordes of raw materials and work in progress in between every stage of production. So if you go 17 steps from buying your raw materials to a finished product, you have an increasing buffer filling up a warehouse in between each of those 17 stages. And then of course the buffer of finished goods. The longer you go from buying raw materials to selling finished goods, the greater your profit in nominal terms. And
one of my favorite articles of yours, Keith, was actually the one where you talked about why Radio Shack did as well as they did in the 1970s, because of their inventory.
Right. And then they start to get into real pressure in the 1980s and following, when the inventory becomes a problem and not a solution.
Right.
So anyway, so then the corporations are selling bonds, which means pushing interest rates up in order to chase prices up. So you have chasing interest rates up. The more rates rise, the more they're doing it. In order to buy the more commodities, the more commodity prices rise, the more they're doing it. Which is, I don't think that's, we'll see, but I don't think that's the dynamic we have today at all. Anyways, I'm just, this whole elaborate extended point to corroborate what you're saying about confirmation bias and models being wrong, and assumptions to the models being wrong, and ultimately the Austrian school, Menger talks about this, and a lot of people think he's anti-scientific in saying that economic knowledge is a priori and not empirical. And of course, modern philosophy creates this dichotomy. It's the Kantian dichotomy of the nominal versus phenomenal, right? It's either pure analytics that has nothing to do with reality, or pure lived experience without any resort to reason or principles of any kind. But what Menger is saying, I think, Menger being Aristotelian, very clearly to me, when you read his method, he's so Aristotelian. He's saying that you have to understand economic principles from the causality of it. Suppose two guys come to market, each of them has wheat that they want to sell to the market. It's not, he's debunking the idea that there's a quote unquote right price for wheat, that all the previous people would have calculated based on the number of people and the number of wheat bushels being produced, and saying that a wheat bushel is supposed to be, or the amount of labor that went into it, a wheat bushel is supposed to be 1 ounce of silver or whatever it is. He said clearly, if two guys come to market both having wheat, there will not be a trade. And that's obvious, right? And then he's going into why. It's not just because, well, I have wheat, you have wheat, so have a nice day, but that my ask price on the wheat is above your bid price. I mean, you'd potentially be a buyer of more wheat if you get it cheap enough, right? Then you could bring double the wheat to market. So anyways, then you get into bid and ask, and you get into that the spread is inverted, and it's it's in neither of our best interests, neither of our economic interests, if we're economizing actors, to trade my wheat for your wheat. What's the point of this? Both of us are going to look for advantage. If at the end of the trade I end up with 1.5 bushels, then I would do it. But of course, why would you? Because then you end up with only 0.5 bushel.
Mm-hmm.
So, you know, he's emphasizing you have to think this through from first principles, which becomes very, very difficult when you're talking about an entire economy. And so then the macro guys love to write a differential equation that purportedly, you know, describes the economy. I'll never forget discussion in Faculty's classroom when he's talking about, you know, this idea of an equation. First of all, he said, you have an integer number of actors. It's a whole number. It's not, you know, down to any fraction. So we'd have to use difference equations, not differential equations. That would be the first problem.
Mm-hmm.
Second problem is people have free will. They're not particles of an ideal gas. And then you have the entrepreneur. But even then, I don't know if he said this, if I said this, that suppose you have 2 steak dinners and 2 hungry people. And so, you know, all these equations would say, I think I brought this up as something, problem with this whole equation thing in class, that, you know, the equation would say, okay, fine, you have 2 steaks to satisfy 2 people, everything's fine, right? Well, what if you have a fat guy in a restaurant eating 2 steak dinners and a starving guy looking through the window? These equations just can't tell you anything like that. And so the central planner is doomed to fail, you know, before he gets started. And not to mention the models are wrong, the assumptions are wrong, the distributions are never Gaussian. Or wasn't that essentially the bottom line for why long-term capital management blew up? Is that it's a power curve, not a Gaussian curve?
It also explains why gold coin or silver coin basically went out of circulation during 19th century America. It's because government tried to fix the price of one relative to the other by stamping the number on a coin.
Right.
Right. So
whichever one's undervalued comes to market, and whichever one's overvalued is either hoarded or gets sold in global markets. You get a better price for it.
Yep.
That's right.
Despite the terrible historical track record of price fixing, it seems like we're still having a go at it. I saw a headline last week that they're talking about putting price controls in for gasoline, you know, for fuel. So just we'll never learn.
And back to the 70s.
Right.
I for one look forward to odd and even license plate days.
I wanna go back to something that you kind of glossed over, Paul, because I think it's actually a really key point. When you were talking about the problems with Monte Carlo analysis, you said that, as it turns out, what your research shows is that a stock to gold portfolio, I think it's like 65-35, or I can't remember the exact proportion, but actually that when you had gold in the portfolio, or if you replaced bonds with gold, you actually had better performance. Tell us a little bit about that, how you came to that. You know, what are your findings there on, you know, what role can gold have in a portfolio, and how it helps performance?
Okay, well, better performance, I think, is a little bit of a problematic phrase. So what I would say is that gold tends to be able to make things more predictable, or it has. I mean, everything that we're talking about right now is based upon past record. It doesn't mean that in the future it's going to hold, but my feeling is that without taking a look at the past, how are you going to make any kind of decisions about what the future might hold? So if you take a look at the past data, and I start with 1971 because that was the seminal event that completely changed the nature of what the dollar was and what bonds are. And I looked forward from 1971 all the way through 2021. And what I found was that the inclusion of even a little bit of gold to a stock portfolio would tend to make year-to-year performance a lot more even. And what's more important is that it tended to make stretches of 5 to 10 year performance much more consistent. And that's a little bit paradoxical, because everybody points at gold and says, hey, look at the volatility of gold. It's all over the place, right? And it doesn't really produce a return. So why the heck would you want to own this? And the answer really goes back to what I was saying, which is that people tend to find religion when the financial assets tend to do poorly, and they tend to focus on gold. And so I think over the past, gold has at least allowed people to stay whole when their financial assets are falling apart. And so I think it behooves everybody to put at least a little bit of gold into a portfolio. And I happen to know that a lot of wealthy families always have done this throughout history, because they know that there have been periods of time when financial assets just basically fall out of bed. And the only thing that they can count on to preserve family wealth is, fine real estate, collectibles, art, antiques, and gold, right? So what I found was that the most consistent performer over the past 50 years was a mix of about, let's say, 1/3 gold and 2/3 S&P 500. I also took a look at foreign stocks, and the relationship wasn't nearly as clean. I mean, some of the conclusions did still hold, but I think part of the problem was that I was taking a look at performance in US dollar terms, and capital flows tend to partially be dictated by how well a country's stock market is doing. When you reduce the amount of gold in that portfolio, the average performance did happen to go up. Average performance meaning average, yearly real return. But the volatility got a little bit higher.
Right.
And so I think the sweet spot for most investors is probably in, honestly, the 10 to 20% level. And the reason why I say that is that although I found that about 1/3 gold seems to be the most consistent, I don't know that a lot of people have the temperament to maintain that kind of asset mix. Other problems that tend to come up are, the frictions of rebalancing. When you sell stocks or sell gold, you're obviously going to be paying a bid-ask spread, and especially if you're involved in physical metals, that bid-ask spread can be pretty punishing, especially in silver, as you know. But there's also taxes, right? So there are certain frictional costs when you do the rebalancing, which is another reason why I think that a lot of people are probably better served with a 10 to 20%. And I think they're probably best served by not rebalancing every year, because, again, as I said, the correlation between these assets tends to become more and more negative with longer holding times. And so doing a rebalance gradually. So for example, if you had a 15% target allocation of gold, you wait to the end of the year, you find out how much you're off, and maybe you rebalance 1/3 of the way. And
I see. That's what you mean by gradual rebalance. So you don't complete the entire. Okay, you don't go back to the target immediately. You kind of scale into that target over time.
Yeah, it tends to be a bit of a more gradual rebalancing. Another approach that I propose is that for a person who's accumulating assets, if you have new funds that you want to deploy, maybe you just use those to buy the asset that's under your target allocation.
Right.
And similarly, when you're on the other side of retirement and you're drawing down your portfolio, just sell the one that's over its allocation. And that way you can minimize the trading frictions that I was talking about.
Right.
Yeah.
When I hear that, it always just makes me scratch my head a little bit, because when you look at, going back to your original point about 401ks, retirement accounts, and when you think about mainstream investing, the 60-40 portfolio, even though it's, I think, coming under a lot of heat recently, still is kind of the mainstay for that world. And it's just like gold has kind of been relegated, just kind of pushed off the playing field. Why is that? Because the data shows something else, right? The data shows that there is a role for gold.
I chuckled slightly when Paul, you were talking about 30%. We did a white paper on that 60-40 portfolio and what happens if you add, I call it a little slug of gold to it. And so we found that without me, I'm not yet going to reveal what I mean by little or slug. We found that by putting gold in the portfolio, and we did probably similar analysis to what you did. We just went back to data, all the data going back to 1971 for stocks and bonds, S&P 500 and the 10-year treasury specifically. And we found that by putting that little slug of gold, you got lower volatility as measured by the Sharpe ratio, smaller drawdowns. So if you're an institutional investor or a retiree, the drawdowns are what you're really worried about. Like above all else, don't have big drawdowns.
Right.
And yes, you want big upside too, but the fact that you might have a big upside next year, if you have a big drawdown this year, is really bad.
Might not be it next year.
And slightly enhanced returns, for the amount of gold that we used, the enhancement of the return wasn't enough to really write home about. But anyways, we by little slug, I mean 4%. Was it 4% gold in the portfolio? Not that we didn't think people could or should go for more than 4%, but rather we felt that we would not come across as a credible white paper in institutional circles. If we said more than 4%, we would start to look like, a little wild-haired and a little woolly to be talking. That's crazy talk. That's outside the Overton window. So we just left it at 4%. And I think, did we mention, Dixon, that if you go with a greater percentage of gold, you get even better improvements? We just had a slight footnote or something.
Yeah, no, you're right. We did.
And moved on.
Right.
And trying to make the case for 4%. And then obviously our case was with yield on that 4% of 3%, then it's a game changer to the portfolio over a time period of 50 years, like 1971 to present. Over that kind of time frame, if you're getting 3% on your 4%, then the portfolio really takes off relative to the 60-40 standard portfolio. That was the point we were trying to make anyways. But anyway, it's just interesting how even in the gold community, if you wrote on Kitco or Zero Hedge or a similar site and said, so I recommend 30% gold in your portfolio, I mean, do you just take yourself out of serious consideration? Do you go into, I don't know. I don't know if you've said that publicly or what the response has been. Whenever people ask me about it, I just say, look, I can't give financial advice. I just think everybody should have some and leave it to them as to what they should say, which is probably appropriate given, my position as CEO of Monte Metals. But I'm curious if you have said anything like 20 or 30 and how people have responded if you said that.
Oh yeah, in my videos, I've shown how a 35%, 65% stock and gold portfolio has basically beaten the pants off of the 60-40 stock bond portfolio over the past 5 decades, and was more consistent in terms of performance. It did not have a decade of bad performance in the 70s or again in the 2000s. It was just pretty much up. I mean, of course, there were swings up and down. You can't have return without having some kind of variability. But I think most people did see that with an open mind. And fortunately for me, I'm a small guy without too much of a following, and I'm an engineer. I've had this thought in the past that the financial industry has grown to resemble very closely the medical industry. And when I say that, what I mean is that whenever you're giving, or whenever a doctor is giving medical advice, he feels a lot of pressure to conform with what the vast majority of doctors in the medical field basically say. And if he deviates and something goes wrong, he opens himself to a malpractice suit. I think the same is true for a lot of financial professionals, especially the credentialed ones, where if they deviate from what everybody has accepted as true and something were to happen, they would either get sued or lose their job.
It's okay if we lose 50% of your value in this bad year, because our benchmark is the S&P 500, and the S&P 500 went down 51%. We outperformed our benchmark. Right. If we do something that's different and non-standard, and therefore we lose the umbrella of a benchmark to hide behind, then what the hell's wrong with you, you idiot? You lost 50% of your client's money. The regulators are going to shut you down, and the clients will become plaintiffs and sue you out of existence.
Yep. And if you have problems, you can always rely on your Monte Carlo simulations, right?
That's right. That's right. And back tested models. Oh, that was the other thing I was going to say earlier about the back testing and the problem in data science is that to your point about, if you're doing 30-year periods and you're writing this in the, let's say, early 90s. So let's say you start with 1925 to 1955 as one period, 1955 to 1985 is another period.
Right.
You really only have 2 good periods plus whatever, another few years before you wrote your paper. Anything in, don't even get me started on so-called artificial intelligence. A few tweets back and forth with a couple of folks about AI, which is really nothing more than, either training models to interpolate, hopefully nonlinear interpolation at least, or pattern recognition. Then, the problem is if you have less data than you think you have, because there's either, as you look at it, there's not very many periods in it, or there's a lot of correlation in your data because 3 variables that you think are independent are really actually 2 dependent and 1 semi-independent. So you have less data than you think. For whatever reason, you can easily overtrain the model, and the model is going to give you a really good fit. Should 1925 to 1955 ever recur, you've got the perfect model to train you for that. So I guess if you went back in the time machine to 1925, man, you just got a great model for what to do. Assuming you didn't have the daily newspaper, ticker or whatever. But in terms of predicting 2025 to 2055, not so much.
Yeah, and don't forget a once in a 1,000-year event seems to happen about once every 10 or 20 years right now. Right, the unlikely event seems to be a lot more likely than the models say.
Isn't that like how every year companies seem to have non-recurring charges?
Right.
It goes without saying, but this was great. Paul, it was a treat to have you. We did not even come close to addressing all of the items on our list. So what that means is we'll just have to have you back on for another show, and we can address the other items on my list here.
Oh, that would be great.
Yeah. Thank you so much. Hope to have you again soon.
Okay. Well, thanks for the invitation, Dixon, Keith. Thank you very much.
Let's do that.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.